What if I told you that a three-digit number, one you might not even know, could be costing you tens of thousands of dollars every single year? Welcome to the credit score system, and today we are going to break it all the way down. Here is a number that should stop you cold. The average American carries nearly $6,000 in credit card debt. Student loan balances total over $1.7 trillion nationwide. And according to FICO, roughly 16% of Americans have a credit score below 580, what lenders call subprime territory. That means tens of millions of people are trapped in a financial limbo, paying higher interest rates, getting denied for mortgages, and watching opportunity after opportunity pass them by. But here is what most people do not realize. Bad credit is not a life sentence. It is a starting point. Credit scores are dynamic. They change every single month. The mistakes you made 3 years ago are already aging off your report. And with the right strategy, you can accelerate that process dramatically. I have watched people go from a 480 credit score to above 700 in just 18 months. Not with magic, not with expensive credit repair companies, but with a systematic, patient approach that anyone can learn. And that is exactly what we are going to walk through today. Before you can repair your credit, you need to understand exactly what you are working with. Your FICO score, the one that matters most to lenders, is calculated using 5 specific factors. First, payment history. This is the biggest one. It accounts for 35% of your total score. Every time you pay a bill on time, you are building points. Every time you miss a payment, you are losing them. A single 30-day late payment can drop your score by 60 to 80 points overnight. That is how powerful this category is. Second, credit utilization, 30% of your score. This is the ratio per value of your credit card balances to your total credit limits. If you have a $1,000 limit and you are carrying an $800 balance, you are at 80% utilization. That is a score killer. The number you want to stay under, 30%, ideally 10% or below. Third, length of credit history, 15% of your score. The longer your accounts have been open, the better. This is why financial experts always say, never close your oldest credit card. Even if you do not use it, keeping it open extends your average account age. Fourth, new credit inquiries, 10% of your score. Every time you apply for credit, a hard inquiry appears on your report. Multiple inquiries in a short period signals financial desperation to lenders. Space out your applications. And fifth, credit mix, 10% of your score. Having a variety of credit types, credit cards, installment loans, a mortgage, shows lenders you can manage different kinds of debt responsibly. So how does someone end up with bad credit in the first place? The pathways are more common than you might think. Medical debt is the silent destroyer. A single emergency room visit without adequate insurance can generate thousands of dollars in unexpected bills. Miss one notice in the mail, and suddenly that debt is in collections, and your credit score pays the price. Then there is the minimum payment trap. Credit card companies want you to pay the minimum. Just the minimum, because at 24% interest, they make money every single month while your balance barely moves. Someone who puts $5,000 on a credit card and only makes minimum payments will take over 20 years to pay it off and spend more in interest than they originally borrowed. And student loans. Millions of Americans entered the workforce with 5-figure or 6-figure student debt, only to find that entry-level salaries barely covered the payments. Deferments and forbearances can protect you temporarily, but they do not stop interest from accumulating. The common thread in all of these, feeling overwhelmed and doing nothing, and that is when bad credit gets worse. Now for the part you have been waiting for, what actually works. Step 1. Get your free credit reports from annualcreditreport.com. All 3 bureaus, Equifax, Experian, and TransUnion, not the ones you pay for. The genuinely free ones mandated by federal law. Download all 3 and read every single entry. Step 2. Dispute errors aggressively. Studies show that up to 25% of credit reports contain errors significant enough to affect lending decisions. Outdated accounts, wrong balances, accounts that do not even belong to you, all disputable under the Fair Credit Reporting Act. File your disputes online, by mail, or by certified letter. The bureaus have 30 days to investigate and respond. Step 3. Write goodwill letters. If you have old late payments but have otherwise been a responsible customer, write a sincere letter to the creditor asking them to remove the negative mark as a gesture of goodwill. It does not always work, but it works more often than people think. Step 4. Negotiate pay-for-delete agreements. For accounts in collections, you can sometimes negotiate directly with the collection agency. I will pay this debt in full if you agree to remove it from my credit report entirely. Get any agreement in writing before you pay a single dollar. Step 5. Build positive history while repairing the negative. A secured credit card, one where you deposit money as collateral, reports to all 3 bureaus just like a regular card. Use it once a month for a small purchase. Pay it in full every month. Let the positive history accumulate. Let us talk about some tactics that most people never consider. The debt validation letter. Under the Fair Debt Collection Practices Act, you have the right to request that any collection agency validate the debt they are trying to collect. They must provide proof that the debt is yours, that the amount is accurate, and that they have the legal right to collect it. Many agencies, especially those who bought old debt from other companies, cannot provide this documentation, and if they cannot prove it, they cannot legally continue collecting. That item may need to come off your report entirely. The statute of limitations. Every state has a time limit on how long a creditor can sue you for a debt. Once that window closes, typically 3 to 6 years depending on the state, the debt becomes time-barred. They can still try to collect, but they cannot take you to court. Time-barred debt carries significantly less weight on your credit report. Finally, credit builder accounts. Some credit unions and online banks offer specialized accounts designed specifically to help people build credit from scratch. You make monthly payments into a secured account, and the bank reports those payments to all 3 bureaus. Simple, effective, often overlooked. Your credit score is not your financial identity. It is a snapshot, one that can change. The strategies we have covered today are real, they are legal, and they work. If this video helped you, please subscribe to Credit Fixed, because every week we drop content designed to help you build the financial life you deserve.